Good morning, everybody. We got some big news from Shopify. They launched Collabs, which is a new way for creators to earn revenue on the platform. But the question is does this mean the stock is a buy right now? I don't currently own it, but I am looking at it. So I'm going to share my thoughts and tell you what price I would actually think about buying Shopify at. Before we get started, I like transparency on this channel. I am building a portfolio from $10,000 to $1 million and sharing every step of the way. We're currently at $97,237. I have put in, since February 15th, 2022, $86,960. That means we're up $10,000 for a money-weighted return of 22%. Here's the portfolio. This is not a full portfolio update. I do those on Fridays on this channel, so like the video and subscribe, turn notifications on if you want to get those updates. But I'm just showing you this to show you I do not own Shopify. Also going to talk about Mercado Libre and Amazon in here because those are other kind of e-commerce players that you have to consider if you're thinking about owning Shopify. So I just want to be transparent and show you I do not own any of those companies. All right, what is Collabs? Essentially, it's a way for Shopify's merchants that use the website and use it to sell to people to connect with individual creators to do new types of things like sales and marketing. So they might find an influencer that is really popular on TikTok or Twitter or YouTube, and Shopify is essentially going to be able to facilitate those partnerships and facilitate that revenue. And I'm sure there is some type of revenue share that would be involved there. So right now, as of this announcement, this is not a needle mover for the platform. There's a lot of other ways and other places and things that influencers can do to either work directly with brands or work through other agencies or whatever, that Shopify isn't necessarily going to be a key value driver for the influencers and the merchants. That's my initial thought. As this thing rolls out, if it starts to get traction and starts to make a difference, then my opinion might change, right? But a lot of times when there's big announcements like this, people get really excited and overexcited and stuff like that. This is a cool announcement. We'll see what happens. That's my take on it. But we still have to own stocks that make sense fundamentally. So when we think about Shopify, stock's down 71% year to date. Mercado Libre is down 21%. Amazon's down 13%. Etsy's down 44%. And C Group is down 65%, right? If we look at 5 years though, Shopify is still up 318%. Mercado Libre is up 335%. Amazon's up 196%. And Etsy's up 674, kind of crazy. And the only ones that have been around for 10 years, and you might not even know this about Mercado Libre, 10-year performance 1,100% versus, and it's even beating Amazon. Kind of insane, right? For this comparison look, I also want to talk about gross margin and just see how these companies compare. So Shopify has a 51% gross profit margin. Mercado Libre is right in line with that. Amazon's a little bit lower, 42%. Why is that lower? Because Amazon has more costs like warehouses and logistics and stuff like that these two don't have as much of right now. Etsy has pretty much zero of that. They don't own any inventory. It's just facilitating sales between buyers and merchants, essentially. That's why their gross margin is higher. And C Group actually has a lot more other expenses that they're into, which is why their gross margin is lower. Okay, let's take a look at net income margin. How far away are these companies from potential profitability? Shopify, minus 38% net income margins. Got to be a yellow flag for people, right? Mercado Libre is at almost 3%. Amazon's right around 2%. Etsy's at 17%. And C Group is at minus 19%. Okay, the other thing I like to look at, cash from operations. Are they getting cash from operations or are they burning cash from operations? Shopify's positive 124 million. Mercado Libre 1.6 billion, kind of crazy. Amazon 35 billion, Etsy 566 million, and C Group minus 833 million. Okay, and then revenue per employee. This is pretty interesting because it shows you just how efficient they are in their hiring and how much revenue they bring in per employee. 461,000 for Shopify, 235 for MELI, 292 for Amazon, 969 for Etsy, and 147 for C Group. So far in these comparisons, Etsy's looking pretty good, not gonna lie. Okay, let's look at them on kind of a valuation basis, a multiple basis. We can't really do it with PE because of the profitability metrics, but we can look at enterprise value to sales trailing 12 months. And then what's most important is actually forward. Okay, so based on forward sales expectations, what is the enterprise value to sales ratio? Shopify's at 8. It has come way down. I'll show you how much in just a second. Mercado Libre is at 5. Amazon's at 3. Etsy's at 6.7. And C Group is at 3. Okay? And when we think about that, growth comes into play here. What is the growth rate? But also things like gross profit margin and profitability come in. So when we see that Etsy has the highest gross profit margin and a pretty high net income, and they generate free cash flow and stuff like that, 6.7 compared to Shopify's 8, Etsy might actually be a much better value, depending on its expected revenue growth, than Shopify, because it's a more profitable company, if Shopify can't turn that around. Speaking of growth, right? Revenue growth. So if we look at what we really care about is how much have they been growing over the last 5 years, their revenue CAGR. Shopify's at 58%, Mercado Libre is at 53%, Amazon's at 26%, Etsy's at 43%, and C Group is at 98%. Okay, so that's the 5-year average. Now, what does it look like going forward? Are they able to maintain that? Well, forward revenue growth expectations, 33% for Shopify, 49% for Mercado Libre, 16% for Amazon, 17% for Etsy, and 56% for C Group, okay? So we talked about that price to sales multiple, or EV to revenue. Etsy's was about even with Shopify. They are more profitable, but Shopify's growth is almost expected to grow twice as fast as Etsy. So then that brings it back into maybe Shopify deserves that little bit of premium valuation compared to Etsy. Okay, that's how we have to think about these things. That's a pretty good comparison. We looked at revenue growth, we looked at comparison of gross profit margin, and then we looked at their EV to revenue multiples. Okay, the two companies I really want to focus in here on are Shopify and Mercado Libre. So if we go over to Fast Graphs, we look at Shopify. This is what I was talking about. Its price to sales ratio got up to 48, and now it is down to 9.73, and this is a blended price sales ratio. If we look back, it got down as much to 7.8, so its stocks jumped quite a bit, but it's still trading at 9.7, which is below its normal price sales ratio over this time. But let's take out the post-COVID because things got kind of crazy after COVID. Okay, so we took some of the craziness out. In my opinion, a good baseline price sales ratio for Shopify from where it's traded from 2015 to 2018 when things didn't get too crazy is an 11 price sales ratio with 45% revenue per share growth rate. That's our baseline. That's what we're looking at. Okay, so if we see here, we have expected revenue growth rates per analysts over the next several years, right? We have a 19.75% expected revenue per share growth rate, and that's the difference here between just revenue growth. This is revenue per share, meaning they're also factoring in things like the company issuing more shares. That's why this number is lower. 19.75% in 2022, 24.61% in 23, 25% in 2024. If we know that the company has historically had a 11 price sales ratio with 45% revenue growth rate, and the revenue growth rate is dropping and it's less than half of that, I don't think it deserves to trade at half of a price to sales multiple, but I think a better price sales multiple to use is something like 9, and that might even be high, so that'll be the high end, right? Okay, so if we think that 9 is a fair price to sales multiple, which I do, and we want to look out 3 years, or at least 2 years, if it stays at 9, you're looking at an annualized rate of return of 19%, which is pretty high, for a total rate of return of 53.75% through 12/31/2024. So let's see what happens out through 2024 at a price to sales ratio of 7.2. Based on this expected revenue growth, you get annualized rate of return of 9% for a total return of 23%. And let's even go up to 10.8 or close to 11. If you get that, then you're looking at a 30% annualized rate of return. So my expectations for Shopify for the next few years is probably somewhere between 9% annualized return, so 23% total return, or at the high end, a 29% annualized rate of return. And so if I think about it, and I think about what Shopify does and the growth potential in e-commerce and their history, it has been an outperformer over time. I think that, this is a pretty decent risk reward to start considering Shopify. When it was way up here, you're pricing in more than perfection at this type of multiple. When it's way down here and everything's so negative about it, you start to have a better potential risk to reward. Now, I don't own the stock, but that's just my thoughts on it. All right, let's jump over and let's see what Morningstar thinks about Shopify. So they think it's a 3-star stock. They have it at a range that they think is considered fairly valued. The fair value is 45. Last close was 39. Economic motive narrow, capital allocation was standard. And so they're pretty much right in around where I'm thinking the same about the stock, right? All right, Mercado Libre. This is one that I think there's a lot of risks because of where they're located. They're essentially a Latin American e-commerce company, right? So there's a lot of different risks that they face that Shopify might not face just because of where their primary market is. But if we look over this company's history since 2006, which goes back a lot further than Shopify, we saw that long-term performance. Its normalized price sales ratio is 11.3 with 36% sales growth rate. Now it's trading at a blended price sales ratio of 5, which is like 40% lower than Shopify, right? All right, we've done the same thing. We've gone to forecast. We have the analyst expectations in, and then I put 15% for those remaining years. Trading at a price sales ratio of 5. And so out to 2024, even if it maintains its price to sales ratio of 5, which is below its historical average, you're looking at a 24% annual rate of return. If it gets back up towards, 7, at 7.2, you're looking at a 39% annualized rate of return. If it gets up to 9, which probably is an unrealistic expectation, you're looking at a 53% annualized rate of return. So in my opinion, just immediately looking at that, if you can handle kind of the international risk and you understand this company a little bit, there's a potentially better return scenario for Mercado Libre than Shopify. Even though Shopify gets kind of all the news headlines and the excitement, Mercado Libre has a longer history of outperforming the market. It's outperformed Amazon over the last 10 years, which is kind of crazy to think about. And it's trading at one of the lowest valuations it's ever traded at as a public company, with a proven history of being able to be profitable. That's pretty rare for high growth companies, and there are certainly a lot of risks with this company. But if you're interested in Mercado Libre, then now might be a good time to start considering it.